for coming out tonight. Appreciate you taking some time out of your night. I'm going to try to keep this to about 30, 40 minutes worth of content, and then we'll open it up at the end for Q&A as long as Q&A goes for. Throughout the course of this, you guys have any questions, type those into the question box, and I'll be sure to answer those at the end of this presentation. So why we're here tonight is to discuss, why it's my belief that in 2024 we are going to see what equates to, more or less a flash crash of commercial real estate, specifically, on the multifamily side of things. There will also be significant distress, significantly more distress, in fact, in office real estate, but we're not going to get into that. We're going to focus on multifamily because that's what I know best, and that's what I really focus on in particular. So, I want to preface this by saying I think a lot of you know I'm not like this person who says everything's going to crash, everything's going to be awful. Infamously, in June of 2022, when everybody thought everything was going to crash on the single family side, I was, probably the most public and the loudest about the fact that the single family real estate market was not in a bubble, and you were not going to see cascading enormous price declines or a bubble bursting or anything like that. People thought I was crazy. So far, that call is looking to be good. I think it's more of a conventional call now as opposed to a crazy call, which people thought it was back then. But again, I just follow a lot of the data and numbers, and what we're seeing right now, kind of before our eyes, is as we get into 2024, I think a significant amount of distress is going to be hitting the, multifamily market. And when I say multifamily, I'm talking, larger apartment complexes, 50, 75 plus units. What we're going to go over tonight is, what is telling us that that is going to occur. So a little bit about me, for those of you that don't know me. My name is Kyle Kovatz. I have a company called Kovatz Multifamily. We specialize in buying apartment complexes in Texas, Dallas, and Houston in particular. I currently own and manage about a little over 1,100 apartments in Dallas and Houston, and I'm also a limited partner on thousands more units throughout the Sun Belt. So very involved in the business, from both in, on the ground standpoint, as far as, understanding what's going on our properties, and from a macro standpoint, seeing what's going on with other properties as well. So let's get right into it here. So we start off with the good times, right? The good times is 2012 to 2021. This is when everybody was buying and everybody was making a ton of money. Between 2012 to 2021, as I say here, really the only requirement to make a lot of money in real estate was to have a shallow pulse. Not even like a hard pulse, a shallow pulse, and you would have made a bunch of money. So the property on the left, I'm not saying that like we didn't manage it. We managed it well. We always had 99, 100% occupancy. We did quite well on it. And we had a tremendous property manager in place and tremendous team. But this is a property we bought in February of 2019 for 11.6 million bucks, and we sold it in November of 2022 for about 25 million. These numbers actually understate the return. We made this when the deal had first closed. This number, this equity multiple, wound up being closer to 4x. What does that mean? That means for one of our investors who invested 100 grand into this deal, their 100 grand turned into like close to 400,000 over the course of a 3.5-year hold between cash flow and appreciation. So, and again, this is a deal where you see our projections. We thought we'd be able to 2x somebody's money over 60 months. We nearly 4x'd it over 45 months. So, and again, part of this, and I would be lying to you if I said it's just because of how good we are at what we do. Interest rates went low, cap rates compressed, rents went up. We bought, we sold at the proper time. We made a ton of money. That's not the story today. The story today, moving along to the bad times, that's 2022 to present. Now the qualifications to be a good real estate investor are to be operationally excellent and, quite frankly, have a little bit of luck on your side, and not be facing a maturity. Because those who are facing maturities this year and the coming year, they're in a really, really bad spot, considering where interest rates happen to be right now, where rent growth has sunk to, and where expenses have grown to. And we'll discuss that. So this is what we're going to be covering tonight: the historic rise in interest rates, which has led to cap rate expansion. And now, furthermore, we're dealing with downward pressure on rents because of an increasing in supply, rising expenses due to inflation, loan maturities coming up, and now people with their hands tied behind their back with almost, I have to take the best of two bad scenarios. We're going to talk about those best of two bad scenarios that these people are facing over the next year. So to begin with, right? Rate hikes. Anybody remember in the summer of 2021, anybody on the Fed and the government was getting in front of the TV saying inflation is transitory? Our president said it. Jerome Powell said it, right? Anybody who can get their face in front of a TV was saying inflation is transitory. Here's the infamous quote, right? In the end, it will be transitory. And that was Jerome Powell talking about inflation. Well, it didn't wind up being transitory to the point where the Fed wound up raising rates at one of the fastest paces ever of all time. We'll go over that in a little bit. Taking us back even to December of 2021. In December of 2021, this was the Fed governor's dot plots. So the Fed members' dot plots, right? So what we see here is they said, yeah, at the end of 2021, we're going to be around 0%. And then at the end of 2022, we're not even going to hit 1%. And at the end of 2023, which we're approaching right now, we'll just get to about like 1.5%. Well, we're towards the end of 2023 right now, and their range right now on Fed funds between 5.25 and 5.5. They were incredibly off on this. They were off by nearly 400 basis points. And what that has done is the people who bought properties at this time, when you're buying properties and you're assessing what type of loan to take out, am I going to take out a fixed rate loan? Am I going to take out a floating rate loan? If you're thinking about taking out a floating rate loan, which is, typically structured as a spread plus SOFR, which tracks with Fed funds, you would say, okay, if my spread is, 320, right, 3.2% over SOFR, well, the Fed's saying that at the end of 2023, Fed funds will be about 1.5. So if it's 320 over SOFR, my net effective rate is going to be 4.7. So people who are taking out these loans, a lot of them said, does it even make sense for me to buy a rate cap? Unfortunately, for a lot of them, they didn't buy rate caps. And based on where rates have gone now, your interest rate is 320 plus SOFR. And SOFR, is around that, 5.3 to 5.5 mark. So now your net effective interest rate is towards the upper eights, close to 9. Upper eights, close to 9. And they might have underwrote this deal at an interest rate between 4.5%. They're extremely debt challenged. And on top of that, if they did not raise additional reserves to buy future rate caps, they're in a heap of trouble. And they're probably having negative cash flow. And they're probably going to be forced to sell because they're not going to meet the lender's covenants to pass to get an extension on their loan for what's called like a debt yield test or a DSCR, debt service coverage ratio test, which we'll talk about later. So this is what it was looking like in December of 2021. Again, how's it going? Fast forward to today. This is the Fed's, most recent dot plot that they put out at their September meeting. They said by the end of 2023, their median dot plot suggested one more hike. Right now, I think the market's pricing last I checked was about a 30% chance of a rate hike at the November meeting. So we'll see ultimately what they wind up doing. Some people think they're done. Some people think there's one more hike. We'll see. The Fed believes that they have one more hike in the cards. They say at the end of 2024, initially, they were thinking maybe 100 basis points in cuts. Now only 50 basis points in cuts. They think at the end of 2024, Fed funds will be around 5%. At the end of 2025, around 4%. And then slowly, kind of trending downwards from there. So a lot of these deals, they're facing a ton of pressure as far as interest rates are concerned. Because now when they go to refinance, they have to refinance at these high interest rates, all while cap rates have gone up. We'll talk about what type of pressure that has put on these operators, on these owners, on the investors in the deal, frankly. So this is just a chart kind of showing just how fast the Fed moved to put it into perspective. So this here shows that over the course of 14 months, they raised Fed funds by about 5%. Again, we have not seen anything like this in our lifetimes. When I say our lifetimes, I'm 32 years old. You haven't seen any, this fast a pace since really the 1970s. That was the only time it was even close to that. And what this has led to is obviously if right now, 2-year treasuries, I haven't checked today, but I think they're around somewhere around 4.8 to 5%, something like that. Well, a bank looks at that and a bank says, well, if I can, place money in that, an investor looks at that and says, well, if I could place money in that and get, 4.8 to 5%, I'm going to need to get a premium above that in order to invest in real estate, a risk asset, right? So what has this done? This is taking cap rates up. And this is just giving an example. If a cap rate for somebody who bought in 2021 went from 4.5 to 6.25, this is an extremely realistic example, in particular for C and B class properties. A class properties have not seen the same type of cap rate expansion. They have not seen the same type of cap rate expansion. However, the B and C class properties have seen this type of cap rate expansion. So again, this example here, let's say somebody bought 2 years ago. And 2 years ago, we're even going conservative on the leverage here because 2 years ago, 3 years ago, it was very, very easy to get 80% leverage, which means, 20% down, 80% loan to value ratio. This example here shows somebody buying 2 years ago, 3 years ago, perhaps, for $100 million with a $65 million loan, right? 35 million in equity. Over the course of the past few years, we have seen crazy rent growth, right? But over the past year, rents are flat. Also, operating expenses on property are up 18% over that time. It is very, very likely that there is a significant portion of properties out there where NOI has actually gone down over the past few years because operating expenses have risen faster than revenues have on the property. In this example here, though, what we're going to talk about is what if NOI stayed flat? If NOI stayed flat here, net operating income, what would happen if cap rates went from 4.5% to 6.25%? Well, using the same exact NOI, what that would do is take this $100 million property in valuation down to $72 million. And again, nothing has changed. The income has stayed the same on the property. What has changed, though, is interest rates have skyrocketed. And with interest rates skyrocketing, what ultimately winds up happening in this case is the valuation goes down because the cap rate goes up. Cap rates and value are inversely correlated. When cap rates go up, values go down, much like a bond. When interest rates go up, bond values go down. It's the same with this here. So what does this look like? If this person is facing a loan maturity right now, if this property is facing a loan maturity, what does this look like? Well, right now, the bank's saying the most that we're going to be willing to lend you is at 65% loan to value ratio. Okay, so what's 65% of 72 million? That's 46.8 million here. 46.8 million. That's the most loan they'll be able to get. But they got a $65 million loan to pay off. So what does this mean? This means they got to bring 18.2 million in additional equity to the table in order to refinance. And if you can't do that, you have to sell. Here's the problem though. If you have to sell, you bought it a few years ago for 100 million. You're selling it today for 72 million. And what has happened to the equity? The equity has shrunk from 35 million to 7 million. To put that into perspective, that's 20% of the original equity. 80% of it is wiped out, which means a $100,000 investor, if they were forced to sell today, the $100,000 investor is only going to get $20,000 back. The other alternative, if they do a cash in refi, since they had 35 million in equity, 18.2 is roughly a little bit more than half of that total initial equity. In other words, their other option is to hit up a $100,000 investor in this deal and say, hey, we need to do a capital call. We need you to bring an additional $50,000 to the table for us to do a cash in refi. Again, you're really just picking the best of two bad situations here. There is no good situation. You sell at a massive loss of both price and equity, or you do a massive cash call to do a cash and refi. There's no good opportunity here. There's no good option here. It's the lesser of two evils, essentially, right? That is how much values get eroded by cap rate expansion. So if you're facing a maturity and you are forced to sell or refi, you're in a really bad spot. Unfortunately, there's a lot of people facing now these maturities. We have the data on it. We'll go over it in a little bit. Secondarily, flat rents. Rents have gone flat. I know every single month you might see the CPI report that says, owner's equivalent rent is up by, these sky high numbers. It's because those numbers lag by traditionally about a year. So the numbers that you're seeing in the CPI right now, those are like these numbers here. Again, it has come down significantly to the point now where rents are nearly flat year over year nationwide. And it's not because we have a demand problem. It's because we are so overly supplied. We have an incredible amount of supply hitting the market. All-time high amount of new supply hitting the market. Why? Interest rates were low. Demand was high on apartments. And what wound up happening is builders took out permits to build all these apartment complexes. Now, what wound up happening? Well, we had COVID. We had supply chain disruptions. This construction got delayed, and it's all coming in a big wave. It's coming in a big wave between 2023 and 2024 and beginning to subside in 2025 and there on forward. But over this year and the course of next year, rents will face downward pressures because of the new supply that is hitting the market, and real estate at its core is really simply supply and demand. Again, you see this in a chart here. Why do we have flat rents? Look at the 2+ unit construction. All-time highs. It's at an all-time high here. And again, this goes back to the 1970s. It's at an all-time high here for new apartments that are under construction. And again, these are all getting finished over this year, over 2024 and the first half of 2025. There will be downward pressures continuing for the next year on this year, all while expenses have gone up and now they're starting to, balance out. But again, there was pressure from expenses going up as well, which we'll talk about in a little bit. And again, here's a perfect story, right? It's all about supply. This is a chart from RealPage. RealPage is a great data source, probably my single number one data source for multifamily information. If you guys are looking for data sources, a great guy to follow is Jay Parsons. I'd highly recommend following him on Twitter. He puts out great content. They do free webinars. I did actually a webinar with them this afternoon, and I did another one last week. They have tremendous content, and they put out a lot of good stuff like this. What does this show? This shows the new supply year-over-year expansion rate. How much new supply was added in the market, and how does that affect the rent growth in that market? Markets that added more than 10% of the total supply to their market of new supply, their rent growth is down close to 2% year over year. However, markets that really have not added a lot of supply, markets where the total new supply that's added is equal to or less than 1% of the total supply, their rent growth is humming along. Their rent growth is close to 2.5%, 3% year over year towards historical norms. So again, you're going to face downward pressure on rents because of new supply getting added to markets. Not every market will be the same. Some markets will add more supply than others. Some markets won't be able to absorb that supply. There are markets adding a lot of supply but have a lot of demand. There's other markets adding a lot of supply and have okay demand. Those markets will face the most downward pressure. Those would include markets like Phoenix, Las Vegas, markets like that, Boise, Austin, markets like that in particular. And again, as I said, it's not a demand issue. Household formation right now, again, post-COVID highs we're at right now. So, as you see here, I don't know if you can see this. I know it's a little small. In quarter 2, 2023, we added 1.2 million new households. 1.2 million new households were formed in quarter 2, 2023 alone. This year to date, a little over 2 million, close to 2.1 million, as you see here, right? So household formation is not a problem. And you guys, anybody who follows me knows that I talk about this all the time. We have the most amount of people in U.S. history at peak household formation age. If you look at the 3 biggest 5-year cohorts of population, the 3 single largest 5-year cohorts of population are all between 25 to 29, 30 to 34, and 35 to 39, which again is peak household formation age. So people are, again, they're growing, right? You have the millennials. You now have Gen Z, which is actually pretty big as well, kind of growing into the point where, they need housing. They're starting to form households, right? And here's the other thing. The reason why demand is skyrocketing is, the harsh truth is people can't afford to buy homes. So if you look at this nationwide average right now, it's $763 cheaper per month to rent the same exact place as it would be to buy it because of where interest rates are right now. And again, this was actually the data from quarter 2. And in Q2 2023, rates were significantly lower than what they are now. In Q2 2023, I know people who are getting mortgages at, the high 5s, low 6s. Now people are getting mortgages in 7.5%, 8% rate. So this number is actually expanded. So this data is actually about a quarter old. But in the second quarter of 2023, the difference between renting versus owning a home, it was cheaper to rent by $763, per month. And as you see here, again, apartment demand is normalizing. So in 2022, it did weaken. It weakened. Why did it weaken? Because inflation was so high. People were scared. They didn't know how high inflation was going to go. Things have started to normalize. And as things normalize, people are saying, okay, I'm good. I'm going to start renting, right? So now what we see is just, demand just kind of right back towards historical norms. So again, we don't have a demand issue. The issue that we have right now is a supply issue. So, and again, here's some really crazy stats I just wanted to share with you. This is from a study done by Axios. So they studied the 50 largest metros in the United States. And what they found is of those 50 largest metros, there's only 4 cities where the average renter earns the annual income needed to qualify for the median starter home to purchase it. Those 4 metros are Detroit, Tulsa, Memphis, and Oklahoma City. Here's another crazy stat. Of those 50 metros, in 13 of them, the average renter actually earned less than 50%, less than 50% of the annual income that is needed to qualify for the median starter home. I know a lot of you who are watching this, you're from the New York City metro area where I'm from. New York was one of the lowest on that. Your average renter in the New York City metro area makes 34% of the annual income needed to just qualify, not for like your luxury home, we're talking your median starter home. So in other words, if the income needed to qualify for the median starter home was, I don't know, let's say just for round even numbers sake, 10,000 per month, they're only making 3,400 a month. They're not even close to being able to buy. And we actually see some of this because I was on, as I told you, I was on that Real Page webinar today with Jay Parsons. The rent growth that you're seeing in Jersey City, Newark Metro, which measures kind of North Jersey in particular, it's some of the highest in the country right now. And the reason why is because, again, the sad truth is people literally can't afford to buy homes. And the other two markets that you guys know that I'm very heavily involved in, Houston and Dallas, for perspective. In Houston, your average renter earns 69% of the annual income needed to qualify for the median starter home, and in Dallas, that's 68%. So again, as I said, we don't have a demand issue. Demand is robust. Demand is actually really strong. We have a supply issue, and that supply issue will persist through the end of 2024 into early 2025 until those deliveries are delivered. So as I said, I think rent growth is going to significantly roar back in 2025, 2026, and we should see above average rent growth in those years, above average historical rent growth. Why? New construction permits for multifamily is down about 43% year over year. We already see, because this is all forward-looking data, when you take out a permit, typically it takes 18 to 24 months for it to be completed. So when you see these permits going down, you already know what's going to happen in the future. Because with multifamily construction, it's not like you apply today, you get a permit today, and you start building tomorrow. Again, these things have significant lag. So we can, it's not being a fortune teller, really. It's just literally looking at the numbers, and you can see in the numbers that, deliveries will significantly drop as we get towards the second half of 2025 and into 2026 because new permits have fallen off a cliff. And as you see here, here's the stats on the new deliveries, right? You see this 2023 skyrocketed. 2024 goes even higher. This new supply that is coming to the market in 2023 right now, as we saw throughout the course of the year, and in 2024 will place downward pressure on rents. Anybody who is buying a property next year, make sure that you underwrite to the fact that in the first year, you're not going to see significant rent growth. In fact, you should probably model out flat rent growth on your renewals. Why? Now, let me also add this little caveat in there. Real estate's local, obviously. If you're in a market where there's no new supply for a 10-mile radius and demand is, sky high because population's moving there, that's a different story. But I'm just talking kind of like, average-wise, if you're in a market that has that new supply, you should be probably modeling near flat rent growth, flat or, maybe like 1%. You're not going to see significant rent growth in 2024. There's going to be downward pressure because of the new supply. But as you see here, it's already starting to drop once you get into 2025. So by the second half of 2025, you're going to be down to 211 deliveries, right? And as we get into 2026, it's going to fall even more because we can already see it in the forward-looking data. So again, with that being said, keep in mind, again, in my opinion, if you're buying a deal and you're investing in a deal, year one cash flow will probably be lower. But as you get into 2025, 2026, 2027, you're going to really reap the benefits by being in a market where we have excess demand due to, again, historic numbers of people at peak household formation age, unaffordability to purchase, and again, a lack of new deliveries coming through. And this is just the population stats. I share this with people all the time. You guys have probably seen this before, but the three largest age cohorts that make up the United States population are all between the ages of 25 to 39. This here is also your peak household formation age and also your typical renter age, right? Where you're forming your first household. As I said, again, this year alone, we're at about 2.1 million households formed already. So again, that number should continue to stay steady as people do begin to, again, form households of their own. Here's the other pressure, right? On top of rents being flat year over year, when I say flat, they're up about 1% year over year, expenses are not. Expenses have, skyrocketed. Between, as you see here, December of 2020 to December of 2022, all operating expenses are up 18%. Property insurance, I don't need to tell you, I think you guys know this, property insurance has gotten insane. Fingers crossed, this year so far, there hasn't been any major, really significant volume of natural disasters and hurricanes and things like that. Fingers crossed until we get to the end of the month when hurricane season starts to, kind of lighten up. But hopefully we get some relief on that over the next year. But again, inflation hit everything. Inflation hit properties, it hit, your payroll, it hit your repairs and maintenance, all of your operating expenses, right? So on top of the fact that your revenues have gone flat because, again, new supply hitting the market, your expenses have not. So again, that challenges the income on the property. So it's very likely that properties that were bought a year, 2 years ago are facing, again, flat incomes year over year. And if they're hitting a maturity now, they're in a really, really tough spot if they hit a loan maturity, because now, again, income has stayed flat. The amount of money a lender is willing to lend you is a smaller percentage, and they're a lot more stricter on the income requirements as far as how much income your property must be making for them to qualify you for the loan. We're going to go over kind of a little bit of a case study of that in a little bit. And here's the data on loan maturities. There's 4.5 trillion in commercial real estate debt maturities by the end of 2025. There's 4.5 trillion of commercial real estate debt in total. 1.5 trillion of that matures by the end of 2025. Some of that is office, some of that is retail, some of that is industrial, but 682 billion of it is multifamily. 682 billion of it is multifamily. There's a good significant chunk of that that is tied to loans that were taken out over the past couple years. And those loans that were taken out over the past couple years that do face maturities, because maybe it was just a 2-year loan or a 3-year loan, and they're not performing, the lender will not give them an extension. And the lender does not give them an extension, they fall into that pit that we talked about earlier with the cap rate expansion, where they either have to sell or refinance, both of which are not good opportunities right now, both of which are really horrible choices right now. Here's a perfect example, right? So here's an example. 5 years ago, you could have bought a property with 80% loan to value ratio, which means if it was a $10 million property, the lender would give you $8 million. Rates 4.5%. They were flexible on debt service coverage ratios. We'll talk about that in a little bit. And you had steady rent growth. What's it looking like today? Today, 65% loan to value ratio. I'm probably being generous saying 6.5% rates. They're higher, but I'm just going to even be generous with this example and say 6.5% rates. 1.25 required minimum debt service coverage ratios. You got flat rent growth that we talked about. You got growing expenses that we talked about. And I'm going to show you in the next slide what that looks like. The next few slides, you're going to see me talk about DSCR a lot, though, and I wanted to go over this just very quickly for those that aren't familiar with it. DSCR is debt service coverage ratio. So if you want to find your debt service coverage ratio, what the bank does is they take net operating income divided by the debt service. So here's a simplistic example. If you have $125,000 in net operating income and the monthly debt service on the property was $100,000, let's say, you would have a 1.25x debt service coverage ratio. Why does the bank care about this? The bank wants to make sure that this property itself, the income generated from the property itself, pays for the loan. They don't want to have to come after you personally for this money, for any shortfalls. They want to make sure that the property by itself, the income that it's generating, is paying the loan. It's paying itself, basically. It's paying off itself. That's why the bank cares about that. They believe that number is a firm cushion. Here's the example. Let's say you have a $10 million loan at a 4.5% interest rate that you took out a few years back. And on this loan, you're only paying interest-only payments. No principal, just interest only. If you run the numbers on this, interest-only payments at 4.5% on a $10 million loan monthly is $37,225. So again, $37,225. And if you have a healthy, what's deemed to be a healthy DSCR of 1.5x, 37,225 multiplied times 1.5 would give you a net operating income of 55,837. Now, most people with this loan, if they talk about I have a 1.5x DSCR, I mean, you're happy, you're joyful, you're super, you would say to yourself, I'm super safe. My debt is more than covered. It's covered by 1.5x. Here's the issue, though, if they hit a loan maturity. If you had to refinance that $10 million loan because you hit a loan maturity, and now rates are 6.5%, well, 6.5% of a $10 million loan monthly is not 37,225. It's 53,892. And again, your monthly NOI is still the same. Your monthly NOI is 55,837. You're not going to qualify to refinance that loan for $10 million. Why? Because what's a DSCR on that? The DSCR, again, my income is the same, 55,837, but now my monthly debt service is 53,892. 55,837 divided by 53,892 would give you a DSCR of 1.04. And remember, the bank wants to make sure that you have a minimum of 1.25 before they'll lend you money. So therefore, we ask ourselves, well, how much is the lender willing to lend me then? So if my NOI is 55,837, the most a lender is going to be willing to lend me is 44,670 in monthly debt service. Because why? My monthly income of 55,837, if you divide that by 44,670, it gives you that 1.25 number. So let's run the numbers, right? 44,670 in monthly debt service, and again, I'm saying just interest-only payments too. 44,670 of monthly debt service at interest-only payments would mean the maximum loan that they're willing to give you is 8.3 million. Again, the maximum loan that they are willing to give you is 8.3 million. What that means is that if they have to refinance, they're going to have to bring an additional $1.7 million to the table because they get 8.3 million from the new lender. They still got a $1.7 million gap to pay off this loan. So again, if we're just using kind of to give a simplistic example, if you had a $10 million loan, 10 million is 80% of 12.5 million, right? So that would mean that there's 2.5 million in equity perhaps raised on that deal. I'm just giving really kind of even, simplistic, numbers here. That means that $2.5 million worth of equity investors would have to cough up 1.7 million in order to refi. 1.7 million is 68% of that 2.5 million. What does that mean? That means if you're a $100,000 investor, here's your option. If they do a capital call, you got to bring $68,000 additional to the table, right? If they had to refinance, you'd have to bring $68,000 to the table, or they'd have to sell, and it's not a great time to sell. So again, it's two bad, options. You just choose which option is the, least worse. We're super fortunate because we don't have any maturities coming up. So, I mean, we're extremely thankful for that we don't have any maturities coming up. But if we had maturities coming up, and really anybody that had maturities coming up, this is the type of situation they'd be facing right now. So again, and let's really kind of lay this out. This is the second part of the example. Again, the first part, bullet point 1, is just the same thing I just mentioned. Again, the example we're starting off with, a $10 million loan, 4.5% interest rate, interest-only payments. That would mean your monthly debt service is $37,225, which again, at a 1.5 DSCR would mean your NOI is $55,837. Same exact example we just gave. So with that being said, what would your current DSCR have to be in order to qualify to refinance that $10 million loan at now 6.5% as opposed to your former 4.5%? What would that number come to? 1.81x. That is a super, super high number, 1.81x. And how do we get that 1.81x? Well, here's the math on it, right? Again, a $10 million loan at 6.5% interest with interest-only payments would imply a monthly debt service of $53,892. All we got to do is multiply that times 1.25, and that gives us $67,365. So in other words, we would have to have an NOI of $67,365 in order to qualify to refinance that $10 million loan at 6.5%. So again, remember our former monthly payment was $37,225. So all we do is the NOI that we would need divided by what our monthly debt service was would mean that we would need to currently, on our current loan, have a 1.81x DSCR in order to refinance. This next slide's going to really draw it home, drive it home to you and just show you how precarious the situation is for a lot of people. That's, the scenario if you had a 4.5% rate. You guys know people with rates less than 4.5%, right? What if your rate was 4%? If your rate was 4%, your DSCR would have to be 2.04 or higher to qualify at 6.5%. If your interest rate on your current loan was 3.5%, your current DSCR would have to be at minimum 2.33x to qualify to refinance at 6.5%. If your current interest rate was 3%, you would need a DSCR of 2.72 or higher to qualify for the refinance at 6.5%. Here's where I think this should be really eye-opening to you. once you get your DSCR even close to 2, almost everybody relevers and refinances and place a supplemental loan on the property to take some cash out of the deal to return it to their investors. Anytime. And let me tell you this. If you have a loan and the DSCR that on the property is like 2.5%, it's to the point where you'll have investors calling you an idiot for not refinancing. And the reason they'll call you an idiot for not refinancing, they're saying to themselves, there's a lot of stagnant equity sitting in that deal. My return on equity right now is pretty piss poor because I might have invested 100 grand into this deal, but my 100 is now worth 250. I want some of that money out. And we can do it because our DSCR is 2.5, 2.72. So what winds up happening when they relever that deal and refinance? They'll typically refinance at a 1.25 to 1.5 DSCR. Well, those people who did that, it was the right choice. The problem is if they now face a loan maturity. Because if they face a loan maturity, as we discussed, what you see right here, these are your DSCRs needed in order to refinance at that same loan amount. And as you'll see in another slide, there's 2,500 loans coming due that have DSCRs below 1.05. Forget 1.81, 1.05. So what are the options on the table? Well, a lot of bridge loans were taken out over the past few years. We have bridge loans in some of our properties. Fortunate for us, our bridge loans are structured as 3-1-1. What does that mean? 3-year bridge loans with additional extensions for year 4 and year 5, as long as you meet certain tests. Fortunate for us, we are at the point where we're on pace to meet those tests and we exceed those tests. We actually just had a property we had to buy a new rate cap on, which I'll talk about in a little bit. So fortunate for us, we're not in that position. However, there's a lot of people who have maybe a 2-year bridge note with an extension contingent upon them meeting a certain DSCR, and they're failing that test. And when they fail that test, the bank says, we're not extending it for another year. What does that mean? That means they have to sell or refinance. Well, here's the problem. If your current lender is not willing to extend it, it's going to be really tough to get a new lender unless they're willing to lend you significantly less money, which means you got to bring cash to the table. And now the question becomes, do you sell at a loss to the equity investors, perhaps not a full loss, but a loss of some of the equity? Or do we refinance and have to bring money to the table from a cash call, a capital call? Again, there is no good option there. Secondarily, as I mentioned earlier, there's people who bought loans on bridge notes and did not buy rate caps, which is unfathomable to me. Even foresight, forget about hindsight. In foresight, it seems pretty crazy not to, take out a floating rate loan with a rate cap. But there's some people who did that, number one. They're screwed. Forget about that. They're really screwed. There's other people who took out bridge loans with rate caps that are now facing rate cap expiration, and they have to renew rate caps. Here's the thing. Rate cap price have gone significantly up. Now, what's a rate cap? A rate cap is a way to hedge your risk. As an example, if I took out a bridge loan with a 3.25 spread over SOFR, if you took out a bridge loan in September of 2021 when SOFR was 0, you were at the point where your 3.25 spread, they would also put like a minimum on top of that at 25 basis points. So in other words, your effective rate would be 3.5. So in a situation like that, you started off 3.5. If you didn't raise additional equity for cash reserves for, in case something unexpected happens, you're in a really bad spot because here's what's happened to rate cap prices. Here's a perfect example. We literally just did this. In September 2021, we bought a property. We have a $25 million loan on it. We bought a 1% rate cap for 2 years. 1% rate cap would mean that hypothetically, if our spread was 3.25 and Fed funds went to 5%, which it did, that your rate would be 8.25 on that loan. But if you buy a 1% strike on your rate cap, now, since you have a 1% strike, that means that your rate cannot go above 4.25 because we have 3.25 over SOFR. And if SOFR is 5%, that would mean 8.25. But if you buy that 1% rate cap, it means that my cap cannot go more than 1% above what my spread is, my 3.25 spread. So net effectively, we are paying 4.25 over the past, year, 2 years. any time that rate, the SOFR went above 1%. Here's how much they went up in price. In September of 2021, we bought a 1% rate cap for 2 years on a $25 million loan. It cost us $33,000. That rate cap just expired. We had to buy a new rate cap. We bought it at a 2% strike, a higher strike, which means our net effective rate now, rather than being, in my example, 4.25, it's now 5.25. The 2% rate cap for only 1 year cost around $800,000. That is a significant raise in expenses. Now, fortunate for us, this property was doing quite well, operating very well, and we paused distributions on this about a year ago or so. And the reason we paused cash flow distributions to our investors is we anticipated this. We said, look, we don't know where the Fed's going to take rates. And since we don't know where the Fed is going to take rates, we do have a rate cap expiring in September 2023. We think it's best to preserve cash for the purposes of buying a future rate cap because we do have money allocated for it. We don't know how much it's going to cost. It wound up costing $800,000. Previously, it cost $33,000. Again, there is a lot of properties out there that don't have cash reserves to do things like this. So this is, advice that if you don't already know this, you're already probably screwed. But yeah, you need to build up capital reserves, obviously. And, if you have deals right now, you should probably pause your cash flow distributions and just build up cash. Because again, while we believe the Fed probably has 0 to 1 more hike, you never know. Remember, the Fed doesn't even know. The Fed themselves said 2 years ago that, inflation was transitory and, rates are not going to go up that much, blah, blah, blah. Well, that wound up being a bunch of, what. We see where you are today, right? And here's the thing. The smart money knows this is coming. The smart money knows the distress is coming to the market. Wall Street, $261 billion in dry powder ready to go. Private equity firms, private equity alone, $261 billion in dry powder ready to go. They see all this stuff. Fortunate for me, I pay very close attention to it, and I have a lot of the same, data sources as them. So I know this is coming as well, and I've been building up capital as well for opportunities like this. So again, this just charts on it. So again, private equity set a new record for total dry powder in 2023. It's up 11% since the start of the year already. And again, it's continuing to grow. This number is probably outdated. It's probably higher than 261 now because this was the Q2 data from 2023. But Wall Street knows this opportunity is coming. So again, my belief as well, if they know it's coming, why should they just take advantage of it? Why shouldn't we take advantage of it as well? And again, that's why, again, we started to see some of the cracks and started to see some of this coming in the latter half of 2022 as we got towards like the fall and winter. And we even bought a deal. We haven't gone under contract in a deal at this point in about a year and a half because we were under the belief and under the, basically following the stuff that we're going over tonight, that in 2024, there was going to be a lot of stress in the market where opportunities were going to pop up and they were going to be super unique because typically distress in the market means dilapidated properties, deferred maintenance, low occupancy, crappy conditions. The distress this cycle could perhaps be properties 90+% occupied, good tenants in place, good income, good collections, but they hit a loan maturity. All they did was hit a loan maturity. That is a unique, kind of position that we're in right now in this state of the market with how fast rates rose. Let's quantify this with some numbers, right? So it's estimated that 1.2 trillion of commercial real estate outstanding debt is troubled. Bulk of that is in office, but 436 billion of it is in multifamily. That was reported by Newmark. Between 10 to 11% of all multifamily CLOs, meaning, short-term loans, in Dallas, Houston, and San Antonio mature over the next year. 6 billion of it in Dallas, 3.7 billion of it in Houston, 1.4 billion of it in San Antonio. I mentioned those markets because those are the markets I look at the most. 2,500 properties have loan maturities by the end of 2024. 2,500 properties, loan maturities by the end of 2024. And as we talked about, if you hit a loan maturity, even if your property's cranking, even if you have super high DSCRs, it's a really bad time to be maturing because the sales market isn't great, because it's tough to get debt as a buyer because of how high interest rates are. The refi market is awful because of how high rates are and, the stringent requirements on behalf of lenders. You're going to be in a, no-win situation there. There's 300 plus loans already on the GSE watch list. These are loans that have fallen back in a lot of cases on their loan payments. They can't even make their loan payments. And here's the crazy one. 2,500 total multifamily loans have DSCRs of 1.05 or lower. 2,500 of them have DSCRs of 1.05 or lower. I mentioned earlier, if your rate was 4.5%, to qualify for a refinance, again, to qualify for a refinance at 6.5%, you would need to have a DSCR of 1.81 or more. There's 2,500 that don't even have a DSCR of 1.05. Now, we don't have the data in regards to how many of these are facing maturities over the next year, but I'd bet there's a very, very big chunk of them. And again, I can't get into private conversations that I've had with brokers and whatnot, and with lenders, but there's a lot of them. Let's just leave it at that. There is a lot of them, and they will be coming to the market because they were hoping and praying that rates came down before they had to go to market. Unfortunately, all that's happened over the past month is rates have gone up. And here's some of my takeaways. So number one, there's going to be an abnormal amount of distress to hit the market in 2024 because of all the aforementioned factors that we talked about. Number two, which I just mentioned, the distress this cycle is different. It's different in the sense that it's not your typical distress where you have, crappy properties that are run down, low occupancy, bad tenants. You could have properties at 90, 95% occupancy, very well taken care of, very well maintained, very well managed, but they just hit a loan maturity. And those properties are going to be the biggest opportunities that are out there. And again, those are the properties that I think Wall Street's probably going to try to gobble up. Number three, due to the distress, 2024, in my opinion, is a huge buying opportunity. We're certainly ready for it. Again, as much as we would have loved to buy a property over the past year, again, we kind of hit pause. We hit pause because we started to see some of this, looking forward. And from speaking with brokers, speaking with lenders, speaking with operators, with themselves, kind of started to sense there were some cracks here. So we kind of hit pause a little bit, hit the brakes a little bit. And now we're starting to, rev the engines because, again, it is very unfortunate that there will be distress in the market. But when there is distress, there's a lot of people who lose money and a lot of money. And there's a lot of people who make money and make a lot of money, right? Number four, the buyers in 2024. You're going to reap the benefits of projected low new supply that is hitting the market in the latter half of 2025 and into 2026, because we've already seen it in the new starts data, right? New permitted construction is down about 43% year over year. That's an 18 to 24 month lag. We know exactly what's going to happen in 18 to 24 months. We still have the single largest amount of people in U.S. history at peak household formation age, all while supply is going down, but demand's going up. So again, it leads into a very favorable environment. And the last bullet point here, for 2024 and 2025, don't project that you're going to see a lot of rent growth. You're going to face a lot of downward pressure on rent growth due to new supply hitting the market. As I said, real estate's local though. It depends upon which market you're going into. I would say if you're investing, have a 5-year time horizon, because in 2024, since there will be so much distress hitting the market, you're going to be able to get deals at prices you thought you'd never see again. You're going to be able to get deals at cap rates you thought you were never going to see again. And when you buy at a high cap rate and then interest rates eventually do come down, the Fed says they'll come down over the course of the next few years. Again, who wants to believe the Fed these days at this point though? But all signs do indicate towards interest rates beginning to come down over the next few years. Cap rates should follow suit. And when that happens and you have cap rate compression, values really skyrocket. And then you'll also go into a time frame once you get in towards the latter half of 2025 and into 2026, 27, 28, where rent growth really skyrockets because new starts have fallen off a cliff. And that's when you begin to feel it. And here's the final slide, right? Here's an example of what happens when cap rates do compress. If you're able to land one of these deals in 2024 at an outsized cap rate that you thought you were never going to see again, let's say in the B and C class space, you might be able to land something at near a 7% cap rate. For a simplistic example, if you had $1 million in net operating income and you're selling at a 7% cap rate, that would equal a valuation of about $15.4 million. Let's say you hold that for 5 years and your NOI on average just grows 3% annually. Just 3% annually. It's modest rent growth, modest income growth in general on the property. What that would mean is that over the course of 5 years, your NOI would go from $1 million to about 1.16. Now, if in 5 years interest rates go lower, and in conjunction with that, cap rates also compress and go lower as well, as opposed to selling at a 7% cap rate that you bought at, you wind up selling at a 6% cap rate. At this NOI, roughly 1.16 million, at a 6% cap rate, your value is about 19.3 million. So you bought it for 15, you're selling it for 19.3. If cap rates go down to 5.5, valuation goes to about 21.1. If cap rates in 5 years go down to 5%, 23.185. Here's the reality. I know a lot of you are watching this and saying, I still see properties trading at 5% cap rates. I know. I'm just giving this as an example. I still see properties trading at 4% cap rates, frankly. I've seen a number of them trading at 4% cap rates, but I'm just giving an example here. What if cap rates go down to 4.5%? Valuation goes to 25.7. What if cap rates go down to 4%? About 29 million. Put that into perspective. If you buy a property for about 15 million and you get 65% LTV on that, that means you're getting a loan for about 10 million bucks. If I sell it for 29 million, that is 19 million in equity. What does that mean? That means if I took on 5 million in total equity, that 5 million turned into 19 million, that's a 4x return. If that 5 million in equity turned into 15 million in equity, again, assuming we have a $10 million loan, that's a 3x return. If that 5 million in equity turned into about 13 million in equity, that's about a 2.5x return. If that 5 million in equity turned into about 11 million in equity, again, that's a little over, 2.2x. If that 5 million in equity turned into about, 9.3 million in equity, that's about, 1.8, right? Which would mean roughly about a 16% average annualized return. This is the opportunity that I believe we will see in 2024. I wouldn't bank on cap rates going down to 4% if you buy something at a 7% cap rate. Now, if you're buying A-class property, you're not going to be able to get it at 7% cap rates. You'll be lucky, frankly, to get it at a 5% cap rate. But I believe if you're buying B and C class properties, these numbers, you're going to see a lot. You're going to be surprised how much you see these numbers because of the level of distress that is hitting the market. Wall Street, private equity firms, they don't want to buy the deals with hair on them. They don't want to buy the B and C class properties that require, all this deferred maintenance. They want to buy turnkey properties. They're going to be very active in the A class space. I'm curious if there's more dry powder ready to go than can even be allocated in that A class space. I think they will start beginning to play in that B plus class space for stabilized properties. But the ones that they can't touch or don't go after, that's where you're going to see these enormous, huge opportunities. So with that being said, I will open it up to questions now. This is my information. So that's my website, kovatsmultifamily.com. That is my Twitter, kovatsmultifam. People I know crap on Twitter all the time. I think it is the single best social platform out there because you could actually learn a ton on Twitter. The amount of information and the amount of conversations I have with people who have no business talking to me on Twitter is incredible. I talk to like the leading national housing economists and things like that. It's incredible. So if you want to see like who I follow on Twitter, I think most of them are good people to follow. I pretty much just follow real estate people and football accounts. So you can ignore the football stuff and focus on the real estate stuff. And then that's my email, kylekovats@gmail. So if anybody wants to be added to our investor list for any deals that we do get over the next year or in the future in general, just email me and put the subject line, hey, please add me to your investor list. I'd certainly be happy to do so. As I always say, I can't promise I can get everybody into deals when we get them, but I always do try my best and certainly will make you aware of opportunities when they do come about. So again, if you want to be added to our investor list, you could just email me and in the subject line, just type, add me to your investor list. So with that being said, I'll open it up to questions. Remember, I don't have the answer to everything, but I'll try to answer things as best as I can. So does anybody have any questions here?